Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday? One thing I want to ask everybody before we get into this is real quickly is what should you want to control in life? So there's three things. Now, the first two, most people understand what they are, or you can kind of guess them. Money is one of the big ones. People say, oh, I want to control money, right? Donna says, my time, my money. Yep, exactly. Money and your emotions. Mary says that. I love the emotions one. That's kind of one of the ones I'll get into in a moment. But money is one of the biggest ones that people will say, hey, I should control that, right? Well, what's the other one? It's your time. So time and money are the two big ones. Now, for me, the thing that I want to control the most in my life is my time, right? That's what I want to control. I like to control money, but time for me is the biggest one above all else. That's why I'm doing this webinar with all of you right now in a motorhome while traveling with my family. They're going to go swimming. I'm going to do what I love to do, which is talk about this concept and share this. So I control that, but you got to control money first. So with time and money, controlling money first allows you to control time. Before you can control time and money, what else do you got to control? Well, it's your mindset. It's your thoughts. And so, especially when it comes to money and wealth, as we go through life, we're essentially indoctrinated, or we are, programmed to think about money a certain way. So as we go through this presentation, what I ask everybody to do is to keep an open mind around what we're talking about, because it does take a shift in your mindset to do infinite banking or to understand how it can work in your life. You got to kind of really make that mindset shift. And, money, that's one of those things that can be very emotional, as who said that? As I think it was Mary said. So it can be very emotional. Now, here's a quote that I want to share with you that we like here at the BYOB. So the problem in America isn't so much what people don't know, it's what they think they know that just isn't so. And as we go through this presentation, that quote is going to become more relevant as we go through this concept. All right. So once again, just kind of keep an open mind as we go through this and ask questions. This is kind of a weird thing that is it makes a big impact to a lot of people when they hear this. So let's just say that you put 100 18-year-old kids into a room and you ask every single one of these 100 kids, where will you be at retirement? What are they going to say? Are they going to say, I'm going to be broke and poor? Of course not. They're going to say, I'm going to be successful. I'm going to be wealthy. I'm going to be rich. I'm going to be powerful, or whatever, right? But here's the reality of it. If you fast forward to age, let's say 60, 65, out of those 100 kids or 18-year-olds, only 5%, 5 out of 100 will be financially secure at age 65. So let that sink in for a second. That's kind of scary. Only 5% of the population, essentially, is what I'm saying here, is financially secure at age of retirement. And here we are in America, or North America, one of the most profitable, wealthy countries in the world, and yet only 5% of people are going to be secure. So the question then is, do you want to be one of those 5 people? Because if you're not that right now, we want to be that 5%. And by the way, this stat, it does not come from thin air. It actually comes from the Social Security Administration. They're the ones that actually track this. And yeah, they're saying that 5 out of 100 will be financially secure. So, and this concept that we're going to be talking about, infinite banking, is a way to be one of those 5, by the way. Just kind of something to, hey, should I pay attention to this, or is this something I should consider? If you want to be one of the 5%, yes. All right, so real quick, who am I? So most of you don't know me. So my name is Brian Fouts. I went to Washington State University. I got a degree in construction management and business, which I don't use anymore, obviously. But I went through my life, like many of you probably did, kind of the hard way, right? I was raised lower income, by the way. My family's a great family, by the way, but still have the original home my parents grew up in. But I was doing the traditional path, right? Go to school, get good grades, graduate, and I'm not gonna say I got the best grades, but have a 401k. So I got a career in corporate America, had a 401k. I had the house, the growing family, I had the mortgage, I had the car loans, I had all that kind of stuff. And I had what everybody told me was the American dream, which felt like the American nightmare to me. I was drowning in debt. I hated my job, by the way. I did not like it at all. And I just was not happy with where I was at. So real quick little side note here. So I had this magazine at a doctor's office I was looking at one time in the waiting room, and it was a financial publication. And I had this article I was reading about millionaires, and it said that the millionaires know their net worth, but everybody else doesn't. And I'm like, oh, guess what? I'm one of those people that does not know. And so that's the piece of paper that I did the math on right there. I was worth a negative amount of money after 10 years in corporate America. And I realized something had to change. I was like, what the heck is going on here? And then my grandfather, who was my idol, he got real sick. And he essentially, he tried to retire to go live his life. And he did. He retired in his 60s. And then he got Parkinson's, leukemia, and he died really early on. And he never got to live that life in retirement. So he gave me a piece of advice before he passed. And he said, hey, Brian, live your life now. If you want to go do something different, do it now. And so I kind of took that to heart. And I ended up leaving corporate America and starting some own businesses. I actually used the concept we're going to be talking about today. I use that concept in my life. And this is one of my tax returns from one of my businesses. This was actually in 2021, I think, or 2020, during COVID. And this was a business that did over 2 million in revenue. And why am I sharing this? Well, anybody can say anything on the internet, but I want to show you that, hey, because of this concept we're going to be talking about today, it transformed my life. And it allowed me to do things like this right here, run this business that taught this concept to other people, by the way. And so it's just something I love to do. But I've had multiple businesses, some good, some not so good. But this has been the main thing in my life is this concept. But it's allowed me to do a lot of things. Like I said, time is my biggest thing. I love to control time. And so these are just pictures of my family doing things after I learned about this and started doing this in my own life. I had a lot of fun experiences. And one of my biggest joys I get is actually sharing this strategy with other people so you can do the same things. And I've spoke on stages about this with other people. I've helped thousands of others learn how to do this concept and put this in place in their own lives. And my gosh, my beard is definitely not as gray in that picture as it is now. That's kind of scary. One thing I want you to understand about infinite banking or this concept is that this is a thing that a lot of people talk about. And so Robert Kiyosaki, his book Second Chance, by the way, talks about this concept. And one of his advisors, by the way, was the one that I learned this from. He was my mentor. So I've worked with a lot of Robert Kiyosaki's personal advisors. Tony Robbins, I've been to a lot of his events. He talks about this concept in his book, Money Master the Game. Then, of course, there's I don't want to call it the Bible, but there's the foundational book called Becoming Your Own Banker, Unlock the Infinite Banking Concept by R. Nelson Nash. He's the one that coined the phrase infinite banking. So those are 3 books I definitely recommend if you haven't read them before. They're great ones to elevate your mindset around money. And then, of course, you've got my friends and mentors, Brent and Kessler and Chris Naugle. They have a book called Mapping Out the Millionaire Mystery that really talks about this concept and their journey on it. And then you've got the other one, The Private Money Guide by Chris Naugle. Now, if you guys want those 2 bottom books, I have them on PDF. So later on in the presentation, I'll put in my email address into the chat, and you can email me that, and I'll send you those books if you want those ones on PDF. So keep that in mind. Now, another thing to consider is, with infinite banking, who has used this concept throughout history? Because this concept has been around for, almost 200 years. It's been around for a long time. So who else has used this? Well, Jim Harbaugh, he was one of the top paid college football coaches. He was actually compensated through this concept. So the college got this on him, and that's how he was compensated. So, colleges have used this. This guy right here, you might not remember who he is. I'm sure he doesn't. Joe Biden. So he actually has 6 policies in place in his life. Walt Disney. So Walt Disney, when he was starting Disneyland or Disney World, whatever it was called back then, no bank would loan him the money. So he used this concept. He had one of these things in place and used this banking system to fund his own the startup of Disneyland. So it's kind of cool. Also, so Ray Kroc of McDonald's, when he was, I don't want to say taking it over, but that's really what he did. He took it over from the McDonald's brothers. During the first 8 years to expand McDonald's, he was using infinite banking to compensate employees and grow McDonald's. So it's kind of weird to think about this. We might not have McDonald's as we currently know it today if it were not for this concept. Pampered Chef, she used this concept to start that. And then wealthy families have been doing this for generations. So JP's, Morgan's, the Vanderbilts, the Rockefellers, especially, they're the first family I think that started doing this back in the late 1800s. So it's been around for a long time. Now, some things to consider is like, what will this concept do, and what are we going to be talking about? Well, one, with infinite banking, what it does is it creates guaranteed generational wealth day one. That's legacy planning right there. It allows your money to grow uninterrupted and compounding for the rest of your life, guaranteed. So that one right there is amazing. So it once again, your money grows uninterrupted, it compounds, and it has guarantees. So kind of a cool place to park your money. It takes control of your money away from the big banks, the ones that want to, basically steal your money, and it puts that control back into your hands. Remember, I talked about control at the beginning. This is one of the ways to gain back control of your money. It also protects your money from lawsuits, from bankruptcy, divorce, and creditors in most states. It's state specific, but it protects your money and privatizes it. But then the main thing it does too, it allows you to be the bank for things that you may normally use a bank for. Real estate investing, college, cars, homes, investments, retirement, all having all of the same benefits listed above. So it's not one or two of these things, it's all of them at the exact same time. So the question to you is, would you like to have all of these things in place in your life? Do you think that would help you build wealth and protect your money and grow your money if you could do all of these things at the exact same time? Now, this is kind of a funny little analogy, but with infinite banking, you've got to think differently about money. So this is called the backwards bicycle, and you can go Google the video. It's pretty funny. But when you hop on a bicycle and we've all ridden bicycles mainly, right? We know how to do it. If you turn the handlebars to the left, the bike goes to the left. Now, with the backwards bicycle, on the video, you can go watch it later on. When the guy hops on and turns the handlebars to the left, the wheel goes to the right, and so he falls over. It's hilarious. And so it takes him some time to learn how to ride the backwards bicycle. So it's the same thing with infinite banking. You've got to sort of retrain the way that you think about money because it's going to be different, like the backwards bicycle. But once you learn how to ride the backwards bicycle, it's very hard to go back and ride a regular one. Same with infinite banking. Once you learn a different way about how money works, it's very hard to go back and go use credit cards and go use bank loans because a different way of how money can work. So keep an open mind. So a couple of things I want to make sure we cover first before we get into the kind of the meat of it is you have to understand why aren't more people successful. So this is called the mysteries of money, but this is why people are not successful when they feel like they should be. And by the way, this is my own personal experience as well. So wealth killers, what kills wealth? Well, taxes. I don't mind paying taxes, but I love to pay less, a lot more. So taxes can kill wealth. Inflation, by the way, that's called the hidden tax, by the way. Inflation just eats your money away. And inflation, by the way, is inflating of the money supply. There's two causes of inflation. The Federal Reserve, which is private, by the way. It's not a federal institution, even though it's called that. And then banks. So banks, what's called fractional reserve banking. Those two things are what cause inflation, by the way. Volatility. Your money, if it's volatile, it can kill your wealth because it goes up, it goes down. It's really hard to control it. Interest. So the average household before COVID, by the way, the average household paid around $19,000 a year in interest, and so that's not money that you control anymore. So interest kills wealth. And then mindset killers. So your mindset, right? That's one thing that I talked about. So following that status quo, fear or FOMO, life in general, what we're taught, and in life as we go through it. So those are the things that can really prevent you from being successful. So kind of keep those things in mind. Now, a couple things to understand about money. So one, what is the definition of money? It is just a means of exchange. That's all it is. Okay. So seashells or dollars or fiat currency, if you want to call it that, that's just what it is. It's a means of exchange. Also, compound interest. So you're going to hear me talk about compound interest, but what companies use compound interest? Nobody really does, by the way. Everybody says banks do. Banks don't actually use compound interest. They pay interest and they earn interest, but they don't really use compound interest. Something else to think about is your dollar. So when you earn dollars today, are they worth more today or in the future? Well, we know that like 20 years ago, you could go into a candy store with a dollar bill and buy a lot of candy. Today, you can't do that, right? So your money is worth more today than it is down the road. So knowing that, think about this. Are taxes going to be higher today or higher in the future? Well, historically, taxes only go up. So understanding that is a big deal. So you want to make sure that you're protecting your money from taxes because they're going up over time. Yeah, so Donna says higher, it's 100%. And so understanding how that your money is worth more today than down the road, would you wait to eat bread or drink milk? Would you buy that stuff, put it in the freezer, and then wait 5 years to consume it? Of course not, because it's worth more today, like money is right now. So think about your retirement accounts, like a 401k, things like that. So we put our money into a retirement account, tax deferred, right? But what happens is that you pay taxes down the road, not today. And so if your money's worth more today, wouldn't you rather pay the taxes today and then get your money working for you tax free? So a 401k is a great example. So the things that we do is that we do things with money that we wouldn't do with things that money buys. So what do I mean by that? This is very important. I want to make sure, I want to pause here for a second because it's very important. So we will not go buy a car or go buy milk and then wait 5 years to use that, to drive the car or consume the milk. We wouldn't do that, right? But here's the thing. We actually would put our money into a 401k and wait to use it down the road. But that's the opposite of what we just said. So just kind of understanding that you want to make sure that you're using your good money today, not down the road, or by the way, both. Now that we're talking about becoming our own bank, we have to understand how banks work. So I'm going to use this example of a car. So we've all probably bought a car before. So let's say that we're going to go buy a car. And let's just say that car is worth $25,000. Okay. Now let's say that inside our bank over here, we have $25,000 of cash in the bank. So we're going to go take the money out of the bank and go buy the car with cash. But when you go to take the money out, let's just say the banker, Mr. Banker Bob, whoever it is, the banker says, hey, Brian, wait a second here. Before you do this, how about this? How about instead of you taking the cash out of the bank, I give you a loan of $25,000. Okay. You leave your money in the bank as collateral, and I will pay you 4% on that money. So the banker Bob says, hey, I'll pay you 4% on the money that you leave in the bank. And then I will charge you 6% on the loan of $25,000. So that's 60 months, right? So traditional 5-year note, and you'd pay it off. So this is a traditional transaction, okay? But in this one, you have the money in the bank earning 4%. So how does the math work with this example here? Well, the monthly payment on the car note, the loan that you got from the bank, is going to be $483 per month, okay? Over the 60 months, that's going to be $28,999 of payments. So that's that note right there. That's traditional. Now, here's the difference, though, with this. The money that you have, the $25,000 in the bank, earning 4%, the future value of that money is $30,525, which means you made $1,526 earning 4% while paying 6%. So Mary says not a good deal, but now what do you think? Is that a good deal now? Because you still have the $25,000 and you have the car and you've made $1,526. My point here is that you can make money while earning 4%, but paying 6%. Now, in this example here, someone might say, well, Brian, if I paid cash, I would have no monthly payments. Correct. Yet if you use cash, wouldn't you want to replenish your cash account? So yes, you would take money out of your paycheck and you'd put it back into the cash account to build that savings back up again. So the cash flow is no different in reality, but you've made money here. Now, the one thing I want to make sure that you all are aware of in this example here, who owns the loan? The bank does. Who's in control of the loan and the payments? The bank is. Okay. Who has the car title for those 60 months? The bank does. So while you made money, you're not in control though. So with infinite banking, I'm going to go through this. You can be in control of this entire situation. You are the bank, which means you own the loan and the title to the car, and you own the loan, and you are the borrower. You are the owner of everything you see here. That's the big thing we're going to be talking about in this presentation. So I love that part of this. Okay, so here's the three big things we're going to be talking about. So one is the machine. What is infinite banking? How does it function? Next up is the marathon, okay? Because building wealth is a marathon, not a sprint. Obviously, you can do things pretty quick, but it's up to you. But this is about building wealth. And then, of course, the last thing is the millionaire method, okay? So how do we build lasting wealth, generational wealth with infinite banking? Okay, so let's talk about the machine first. What is the machine? So I like the analogy of a car. To make a car go down the road, it has to have an engine. So to make infinite banking work, which is like a car, you have to have an engine to make the whole concept work. And that engine is nothing more than a specially designed, that's key right there, specially designed, dividend-paying, permanent whole life insurance policy from a special mutual insurance company. These companies, by the way, are very, very large and they're very old companies. So that's it. Now, you might be saying, well, why life insurance? Well, you're going to learn about it because it is one of the most financially secure strategies or institutions in the world. So that's why. Now, you might be asking the question is, well, okay, so who else does this? So I always want to mention this here. So it's called bank-owned life insurance. So we're talking about being the bank, okay? And we use traditional banks to do most of our loans and transactions. But guess who owns the most life insurance? It's banks. So traditional banks, they own more life insurance, this kind, by the way, than they do their real estate and buildings combined. So they're doing this concept with your money. So all we're talking about is kind of bypassing the banks and doing one of the same strategies that they're doing. And yeah, and some people ask me, well, why do they own this? Well, that's a whole other conversation, but you can go look it up online, by the way. It's called Bully, bank-owned life insurance. They own a ton of the stuff. And I've even had a client, local credit union, he was doing a presentation to their executives. And I told him, hey, ask them how if the bank has life insurance on them. He came back to me and said, yes, they said they all have life insurance and the bank is the ones that started it. So they all do it. All right. So once again, so I mentioned that you can earn 4% while making 6%. We're going to flip the whole script though, because we want to make sure that we are actually the owners of this entire transaction, like I talked about, right? So that's what we're going to talk about. But in order to understand being the bank, we have to understand how banks function. So this is kind of this is mind blowing how they do this. So this is called fractional reserve banking. So I want to give you an example. Let's say that you deposit, let's say $100,000 at your local bank, and let's say that bank's going to pay you 4%. So that right there is a liability to the bank. Okay, it's a liability. But do they just sit on your money? Well, of course not. They don't do that. They put your money into motion because money in motion makes money. So what do? Well, they loan it right back out. Maybe it's on a home, mortgage or something like that, or a 7-year arm, something like that at 7%. But what does the seller of that home do with the money? Well, they put it right back into a bank again. But the bank does not sit on that money either. They put it back into motion. Maybe it's a car loan at 8%, something like that. What's the car company do? Well, the car dealer puts the money right back into the bank again. What's the bank do? Loans it right back out again, maybe on a home remodel, something like that. What's the contractor do that remodeled the home? What do his employees do? They put it right back into the bank again. Bank loans it back out. Maybe it's a debt consolidation loan at 12%. Credit card companies put it right back into the bank. So this is money in motion. And then the bank just keeps that money rolling. So what's that mean? It means they make 500% more off of your money than they're paying you. It's just math, by the way. And that's insane right there. So they're putting your money into motion. So they make a lot of assets out of your money. That's what's going on. And by the way, you can look this up. Is actually you can go to bauerfinancial.com and they actually have to disclose as banks do. And you can see how much banks have made today and historically on the money you leave there. It's between 400 and 1,300%. So a very large percentage. All right. So in order to understand why you might want to use infinite banking in your life, we have to look at the annual pattern of how the average household spends money. So for every dollar that you come in control of in your hands, here's how it goes out. So around 20 cents of every dollar goes to automobiles. Around 30 cents of every dollar that you bring in goes to housing, mortgage, rent, things like that. Around 40 cents goes to everything else. Think of things like food, clothing, entertainment, that kind of stuff, an RV as an example, that kind of stuff. And then around only 10 cents of every dollar goes to savings. Now, I'm not going to talk about, the savings. We want to build that up with infinite banking. So that's what I want to focus on. So let's look at what it would look like for you if you're able to capture the interest that is going out to all of these things. All right. So let's look at the savings, how we're going to build that back up. So with the example of the automobiles, around 5 cents of that 20 cents, so 20 cents goes out, around 5 cents of that is actually interest. So let's say we recapture that back into our own savings, our own hands. That builds up our savings. On housing, it's of the 30 cents, it's around 25 cents of that goes out to interest. Mortgages, right? They're very, very high end interest in the very beginning. So let's recapture that back into our savings. Now, for everything else, that's 40 cents going out the door. Around maybe 5% of that is interest. That's credit cards, things like that you use to spend on those things. So let's recapture that 5%. So now when you start to control your money and control where it's going, and you are the bank, you can actually start to build your savings up because you're the one in control. That's really what is going on here. Now, let's look at an example. Let's look at how you can use infinite banking for buying a car. Now, I'm a classic car guy. I've owned quite a few over the years. So I'm going to use that as an example. But let's look at how you can get all that money back for every car that you'll buy, drive, and own. Before we do that, let's look at the machine, infinite banking. So this is what's called a tabular detail, and this is you're going to see a couple columns here. So one, you're going to see what's called deposits. Now deposits, by the way, we call them they're called premiums, but we call them premium deposits because with infinite banking, when you deposit funds into the policy, you get what's called cash value back out of it. Now these are very conservative numbers, but you'll see here there's cash value. So as you put money into the policy, you're going to get cash value. Okay. And the more you put in, the more you get out of it. And then these policies earn dividends as well. And so the dividends come in as cash value. So your cash value is going to be growing for the rest of your life. And that's what you can borrow back out of it. Now, age. A lot of people say, well, Brian, I'm 61, I'm 65, I'm, whatever, does it matter? Not really, because you can use infinite banking a lot of different ways. Lucy, as an example, who's on this call, she has policies on her grandchildren, and she owns them. And so I helped her set those up, by the way. She has policies on herself as well. So there's lots of different ways to use infinite banking. Death benefit. Yeah, because age doesn't really matter. You can use this in lots of different ways. So a lot of people look at the death benefit. What is that? Okay, it's a benefit, but it's not the focus with infinite banking. Like it's right over here. It's a side benefit, but it is not the focus of infinite banking. Okay, and I will talk about that a bit more in here as we go through this. All right. So in this example, we're going to make deposits that can be annual, it can be monthly, doesn't really matter. But we're going to say $10,000 per year. That's just an example of a premium deposit. Your numbers are your own numbers. It could be, depends on your age and stuff, but you can be higher, lower, whatever. But I'm just going to use 10,000 as an example. Now, as we do this, as I said, you're going to earn what is called cash value in that account, okay, in the money multiplier account. You can see it's growing. Now, you can borrow against that cash value, okay? That's called a loan provision. The loans, by the way, are guaranteed. So let's say at the end of year three, you go and you borrow $25,000 out of the policy. That's a guaranteed loan, by the way, and you go buy a car. So now here's the thing you want you to understand. Because you are the bank, you're going to be a responsible banker and you're going to pay back that car loan. So let's just use the same example as we did before. We're going to pay that back at, $500 per month. That's going to be $6,000 per year. So you're going to do a 5-year note back to yourself. All right, I need to pay that back. So what does the math look like so far with this policy? So deposits, you put in $70,000, but you also paid back the car loan. That was $30,000 over the 5 years. So you put $100,000 into the policy, so to speak. But keep in mind, you also took out $25,000 of cash. So in reality, you only put in $75,000 because you had $25,000 of cash. But you have $67,000 right here of cash value in this policy. So you've recaptured 91% of all the money you put into this policy. Now, by the way, that is super conservative. Typically by year 10, that would be 110% on the way that I would do these. But once again, I'm trying to be very conservative here. But in the ones that I build for you, you're going to recapture over 100% of the money by year 10. It's absolutely mind-blowing when you see these numbers. Okay, but now what I want to do is I want to look at years 8 through 12. Now in years 8 through 12, you put in 0. So in these 5 years, you decide, hey, you know what? I'm going to go do maybe another infinite banking policy. You can have more than one, by the way. And I'm going to put in no more premiums, no more deposits. So you can do this. So the premium deposits in these policies are not for your entire life. You can drop them down to 0. Now, let's say that you have a child and they want a car. So I have a teenage daughter. That's the whole other story right there. But in year 8, let's say you go buy another car for $25,000. So same thing, you pay yourself back, right? So you borrow that, that's a guaranteed loan, you borrow it out, you pay it back at $500 per month, $6,000 per year. Now what does the math look like? Okay, at the end of year 12, you've put in $30,000, okay? But here's what I want you to understand. You also took out $25,000 of cash. So in reality, you only put in $5,000 into that. But here's the thing, from year 7 to year 12, your cash value, because of dividends, which come in every year, It grew by $23,592, but you only put in $5,000. Now, here's what I want you to understand. So here's what's happened. In this example, you put in 75,000 in the first 7 years, you put in 5,000 in the following 5 years. So in 12 years, you've put in $80,000, but your cash value is $91,000. You've made money and you own your two cars outright versus just paying a loan to a bank. You'd be out like $70,000. In this scenario, you have 91,000. You also have the guarantee, all those kind of things. These are private loans, by the way, 100%. So that's in a nutshell what infinite banking can do with a very simple example of buying a car. You've actually made money and you own the cars. It's incredible. And there's guarantees, privacy, protection, all the kind of stuff. Now, with infinite banking, there's 3 rules. Pay yourself first, be responsible, and recycle, recapture your money. So what are those rules? 1, pay yourself first. So most people pay your bills first, you pay the bank first, pay the credit card company first, and then you pay yourself last. In this, we want to pay ourselves first. You have to flip that script right there. You have to really kind of change the way this works, okay? You've got to pay yourself back with interest. Be a responsible banker is what we talk about, okay? So if you're going to borrow from your bank, pay your bank back, okay? It's your bank, by the way. And then recycle and recapture your money. That means put your money into motion, okay? So those are kind of the 3 rules we talk about with infinite banking. So if this works for a car, what else? We're going to get into that. All right. So one of the other big things that steals wealth, like I talked about at the beginning, is debt. Debts destroy wealth. And so unfortunately, a lot of people, that's how they survive, is off of debt. So one of the main 2 steps to building wealth is 1, get rid of bad debt, and 2, put your money to work. So a lot of our clients will use infinite banking to pay down debts a lot faster, quicker, and recapture all the money. So I'm going to show you an example of how this looks. So in this example, we're going to look at a doctor. So this doctor is 45 years old. He's a chiropractor, by the way. This is an example. And very conservative numbers, by the way, when I go through this. This doctor has 9 third-party debts. You can see them right there on the screen. He has a total of $5,777 going out every month to these debts, $69,000 per year. Now, if this doctor, and by the way, it's $478,000 of debt. Now, if this doctor paid all these debts as scheduled, it would take him 19 years to pay down all of those debts. But do you think he's going to just pay them all off and not get back into more debt? Well, that's the problem, is a lot of people have this cycle of getting back into debts. We're always in debt. So this doctor wanted to change things. So here's what we did. Okay, so $47,000 or $478,000 of debts. So here's the payments. So this doctor said, hey, I'm going to take some money. I'm going to start an infinite banking policy. So the way that he did it is he did an annual premium of $25,000 into a policy. Okay. Now I'm going to pause here for a second. So where's the money coming from? So you might be asking, well, Brian, I don't have $25,000. These are his numbers. Your numbers are your own, by the way. So we would go through those on a call. But he's a doctor, so he has a high income. But he didn't have a lot of extra money coming in, the disposable income, as we call it. So what he did is he took money that was going into retirement vehicles, 401k, IRAs, things like that, and he redirected those funds into infinite banking. So his cash flow did not change. Now, when you deposit money into the policy, that's called the premium deposit, day 1, you have cash value immediately. Now, this policy for him was very, very conservative. So within the first 30 days, he was able to borrow back out of it $14,863. Typically, it'd be right around maybe $20,000. But once again, we did a very conservative policy for him because of how he wanted to build this. So here's what he did, though. So within 30 days, he went and borrowed out $14,863. That's called a policy loan. And he paid off the Discover card, the Lowe's card, and and part of the Nordstrom's card. Okay, that's a thing, a loan provision. Now, what happened is his monthly payments decreased by $448. Now, he's still paying on the other debts because he still has that money. But here's what we did in year 2 now. So during year 1, he recaptured that $448. That's called the recapture cycle, right? So in year 2, he made another deposit at the beginning of year 2 of $25,000. Now, his cash value available right after that deposit was $16,571. Now, if you're asking, why did it go up instead of being $14,000? Why is it $16,000? Those are called dividends. So every year you're going to earn dividends. Now, he recaptured the 448. He recaptured $5,374 back in his own pocket, which means that the total cash that he has available now is $21,945. So he borrows that back out of the policy. He paid off the endorsement card, Wells Fargo, the private loan, and part of the BMW loan. Okay. Now his monthly payments dropped by $1,917. Starting to see the picture here? Now in year 3, same thing. 25 goes in. His cash value jumped up by 25,000 that year, went up by a lot. The payments of 1,917 back to himself are worth 23,000 and change. So the total cash is 48,545 that he has. So same thing happens. He borrows out from the policy, pays off BMW, pays off the West Marine. That must be a nice boat. And he paid off part of the condo. Okay. So now his monthly payments dropped by $3,677. Same thing's going on here. So in this policy, we had put in 25,000 over 3 years. That's $75,000. We borrowed back out around 55,000. Okay. So the question is always this: so you're earning dividends on the policy. So because I've taken out this $55,000, how much is left inside the policy earning the dividends? Is it $20,000? No, it's not. It's actually the full 75. So you still have the same amount of dividends coming in, even though you borrowed against this. That is the uninterrupted compounding right there. So, and you're always earning those dividends. All right, let's go to year 4. Once again, 25 goes in. Cash value, that's premium deposit, 25,000. Cash value jumps up by 26,304. The payments are 3,677 back to himself is 44,124. Total cash available is 70,439. So once again, same thing happens. Borrows out, pays off a huge chunk of the condo. Now, the difference with this one is the condo and the house are amortized loans. So on an amortized loan, when you pay the balance down or the principal, the monthly payment does not change. So his monthly payments don't change in this example. Now he's still paying on those debts, even though he's paid off a big chunk of them. Keep that in mind. So in year 5, now year 5, we do something a little bit different. So we're going to pay off the condo. So we put in 25,000. That's the premium deposit. Cash value jumps up by 27,000. The payments back to himself are the 44,124. The total cash is 71,225. So now he wipes out the entire condo and a big chunk of the house. So that's what happens. Now, year 6. Now this doctor is like saying, "Hey, this is awesome." Oh, by the way, yes, his payments dropped by now 4,556. They dropped down by a lot. So the only payment he has now is the house. Now this doctor's like, "Hey, I love this concept. So I want to do more. I want to open up another policy. I now have more cash flow because my business is doing well, chiropractor business." So he wants to do a second policy. He's going to do the exact same 25,000 loan on the second one. But he decides in year 6, this is year 6, by the way, I want to drop my premiums on the first policy down to 10,000 and then do another 25,000 on the second policy. So now I'm doing a total of 35,000 between the two policies. So here's the cool thing. So look at this one. So he puts in $10,000 into the first one instead of 25, but the cash value goes up by $13,000. So he's getting more out of it than he's putting in. On the second one, he puts in 25,000 and gets immediate access of cash value of 14,863. So the total that he has available is going to be 82,000. So that's the payments back to himself of 54,000. That's the 4,556. And the cash value of the two policies is going to equal 82,000 total. So now what's he do? He borrows out 76,450 to pay off the house. And now he's zero debt and he's debt free. And he's recaptured $5,777. Now that's year 6. Now in year 7, what does he do? Well, actually, it's by the way, it's year 6 and then year 7, because this is the beginning of year 6. So years 6 and 7, he takes the 5777 number and he puts it back into his policy to pay off his policy loans, because he wasn't making any payments on those for the first 5.5 years, so to speak. And he pays back that policy loan. So at the end of year 7, zero debt, multiple 6 figures of cash value in his policy that he can now put to work and invest to start building wealth or go buy a car, whatever he wants. So he's debt free in 7 years instead of 19 years. And he has a policy with 6 figures of wealth inside of it that he controls and then can now go put to work and build wealth. So that is how you can really flip the script in your own life. Now, you might be saying, "Well, Brian, that sounds very complicated. How do I do that?" Well, we actually show you how to do it. It's called the Debt Blaster software. We use this. It's a proprietary thing that we built. that will map out the monthly way or yearly way that you do what I just showed you to pay down those debts as fast as possible. And it will map it out for you so you can see how long it'll take, how much interest you'll save, and how much wealth you'll build in the meantime. And so one of the things that we do, this is a question I get quite a bit, is, okay, so how do you guys help us do this? Yes, we have what's called an implementation team that actually will walk you through how to use infinite banking, how it functions, how it operates, all that kind of stuff. And that's an ongoing support service that we provide. There's no cost to it, by the way, but that's something that we do for sure. All right, now let's look at the last section, the millionaire. So what if I don't have any bad debt? What if I don't need a new car? Can I still benefit from privatized banking? Should I do this? The answer is an absolute yes, because that's actually where the fun begins. That's where building wealth starts. So Shane, as an example, I think he's doing some other things, but he's doing Turo. So he used infinite banking to expand his car rental business, and that's how he eventually, was able to leave his W-2. All right, so here's some other things that people use infinite banking for. So real estate investors, wholesalers, flippers, that kind of stuff, commercial properties, apartments, mobile homes, things like that. Private lending on real estate is very common, very common. Business owners use this to expand their businesses. I work with a lot of business owners or people that want to get into businesses. Stocks and options traders sometimes do this, like they're doing option trades. Startups, so people start their own businesses. Equipment flipping of all things. So we have a partner that does equipment flipping that you can do with this too. So there's lots of ways to build that. Let's look at an example of private lending. So in this example here, so you're going to see some columns here. So this is called a tabular detail of a policy. You're going to see the premiums right here. You're going to see the cash value. You'll see two cash value columns. One right here, which is the guaranteed, and one over here, the non-guaranteed. This is the one that we look at on the right-hand side. So in this example, this person is putting in, keep in mind, this is their numbers. Your numbers are your own numbers. They're putting in $50,000 premium deposits every year. So you'll see that right here, 50,000, 50, 50, 50. And they're putting in a $100,000, we call it a dump in, or a lump sum dump in, okay? That's optional, but this person said, hey, I want to put in $100,000 in addition to the premium of 50,000. And so they put in 150,000, but they had immediate access to $132,000 at the end of the first year. Now they have immediate access day one, and then they have cash value at the end of the first year of 132. Here's how the numbers work though. So you can see how the cash value is growing year over year over year. So it's always growing. But look at the premiums. Premiums are going down, by the way, over time. They're not going up, they go down. All right. So I'm going to look at year 8. So in year 8, you can see the cash value went up by $66,000. So it grew. So their banking system grew by $66,000 in year 8. But guess what? They only put in $48,000. You can see that right there. They only put in $48,000 in that year of premium deposits, but it went up by 66. So it grew by $18,000 and change. That's a 37% cash on cash return. So who here would like to get a 37% cash on cash return on your money? Let's say that you private lend that money. And so let's say you lend it out at 12%. Now the loan that you borrow from your policy has a 5% interest rate. Let's just say it's 5%. So when you private lend the money, you're getting the 37% plus the 12% on the private loan, and you're paying 5% on your money, which, by the way, those are the dividends that come back in, offset that. So you're getting a 44% cash on cash return. Now, if you just private lent the money, okay, now, by the way, we did nothing other than where the money went first. Now, if you private lent the money, you'd make 12%. If you did it through infinite banking, you're making 44%. It's a very big difference. Now, yes, I'm talking 8 years down the road, but guess what? You can private lend the money starting day one. Day one, year 2, year 3, year 4, year 5. It's just the longer this is in place, the higher and higher those returns are going to be. Now, what am I talking about? How's this happening? It's called compound interest, but it's uninterrupted. So look at these percentages. 21% cash on cash, 26, 54. Now, these are 10 years down the road, 15 years down the road. You have 115%. Look at the access to capital. 121, 126, 154, 215. Those are always going up, and it doesn't matter if you borrow from the policy or not. If you take a loan or not, it doesn't really matter. These percentages do not change. That's uninterrupted compound interest. Very, very powerful. Okay, so millionaire method. So how do you eat an elephant? We've all heard this before, right? It's one bite at a time. And then the other example I always give is, how did the man at the top of the mountain get there? Well, he took a first step. He started climbing there. And so a lot of people, they see the people at the top of the mountain saying, one step at a time, one bite at a time, and you'll get there. With infinite banking, it's a bit different, though, because you have guarantees of your money, guaranteed growth. Whereas if you just do real estate, things like that, you don't know what's going to happen. There's not a lot of certainty around those kind of things. Yes, you'll build wealth, but it's going to be obviously up and down. Whereas infinite banking, it's very, very, very consistent. So this works for debt and expenses. So what else can it work for? So it can work for real estate investing. So if you say, oh, Brian, how do I put my money to work? How do you guys show me how to do that? The answer is yes, we do. So this is another software that we built called the Gain Projector, which just shows you, hey, if I'm going to, the previous slides were examples of this. So if you're going to go buy real estate or invest in real estate or something like that, or an investment fund, we will actually use your policy, the numbers, and the investment you're going to be doing, and we will map out how your wealth will grow over that time frame. And so we have a lot of different softwares that we have done that can show you how it's going to grow, how it's going to work, and how you should do it. So we help you do what we're talking about, because we do this in our own lives, by the way. That's exactly why we do this, is because we do this for ourselves. We'll show you how to do it as well. So now that you understand how infinite banking can work, and I have some more slides and some more illustrations I'm going to show you. I'm going to give you some different examples of how they work and how the cash value grows, so you can get a better idea of how this works, and also some other aspects of infinite banking. But the next steps is you can go to brian.beyourownbanker.com/TBC, and you can schedule a call directly with me. Okay, so I just kind of like this picture right here. So make that money work for you. So that's really the overall concept of infinite banking is, we want to build wealth. We want to be, free. We want to be in control. So you've got to flip the script. You can either work for your money or start to get the process going so that your money is going to start working for you. And that really is the picture right there, right? You got one guy whose money working for him, and you got the other person who's working for their money very hard. So you want to sort of kind of understand that that's what we're trying to do with infinite banking. We're trying to move that to the money working for us side of the equation. So some other things I want to make sure that we are clear on and cover here real quick. So we didn't talk about death benefit. I'm going to talk about that here in a moment. The loans, we're going to talk about the loans because they don't have to be repaid, honestly. We're going to talk about the internal values, how they grow tax-free. We're going to look at how the policies are exempt. So they are exempt from judgments, from liens, and court orders in most states, by the way. So your money is protected with infinite banking. You can actually create tax-free retirement with infinite banking because policy loans are not taxable. So if you take loans out, they're not taxed. So later on in life, take a loan out, don't repay it, tax-free income. All right, so let's talk about generational wealth. So that's called the death benefit. So in this policy right here, this is a 42-year-old female. You'll see that right there. This person is putting in $20,000 per year for 5 years, and then they drop the premiums down. But what I want you to look at here is the death benefit. So look at year one. At the end of year one, she put in $20,000, and the death benefit is $325,000. That is what? How many X is that worth? What should we put into it? You put in 20. That's what is that? 4, 5. It's like 15 times, 16 times what she put into it. Like that's incredible. Now, granted, that's a death benefit. We don't want to pass away prematurely, but if something does happen, her money is going to 15 times itself for that next generation or her beneficiaries. And then look at in year 5. Year 5, she's put in, $100,000 total. You see it right there, $100,000. The death benefit has grown to $483,000, almost 5 times what she put into it. So as these policies grow, the death benefit is always going up over time, along with the cash value. Keep that in mind. So that's generational wealth right there. So let's talk about the policy loans real quick for a second. So policy loans, they're guaranteed, by the way. So if you have your policy is in good effect, a good standing, they call it, your loans are guaranteed. There is no credit check. There is no approval. Ask and you shall receive. So you don't have to qualify for the loans. It's your money. You get that loan guaranteed. The loans are also private. They do not go on your credit report. Very important thing. You go buy a car, go do something. It does not show up in your credit report, does not affect your credit score. There are no minimums or maximum payments on the loans. You are the one in control. There is no required payments on those things. So if you miss a payment, honestly, nothing happens because there is no payment required. So you're in control. So think about being the bank. Well, you are the bank. You own the loan. You're the one that decides how much you want to pay, when you want to pay it back. All right. Another quick question I get a lot is, how can I fund the banks? How do I put money into this thing? Well, the first one is the premium deposits, like we talked about. Now, I mean, it could be, if you're, it could be 500 per month, could be 5,000 per month, depends on what you qualify for. But those can be monthly, they can be quarterly, they can be annually. It's how much, it's up to you, and you can change that, by the way. 10 times your age per month is like the minimum to start a policy if you want to do that. But the maximum is depends on the individual. It's around 25% of your gross revenue divided by 12 for monthly. So that's the range of what you can look to put into the policies. But on a call, we would just go through those numbers for you. On top of the premium, you can do what's called a upfront large dump in. So you put in, let's say, $1,000 per month. You could put in a 5, 10, 15, 20, $50,000 lump sum dump in at the very beginning. Now, why those are very popular is because you have access to 90% of the dump in within the first 30 days. And so right off the bat, 50 to 90% to cash value right off the bat. Now, as you can see in the illustrations I showed, the longer this is in place, the more access to cash value you have. And I'll show you an illustration that illustrates that. So the question always is this: would you put in $1 in order to get $3 back out over time? Most people would say yes. So here's an example of what I'm talking about. So in this example, this is a female, 32 years old. She's putting in an annual premium of $10,000 per year. Once again, that's her numbers. Yours can be different. Doing a lump sum dump in of $50,000. So at the end of the first year, by the way, these are all end of year numbers, she has access to $55,535. In year two, she puts in another $10,000 annual premium deposit. The cash value at the end of the year went up by $10,607. So she has more cash value growth than what she put into it. So she's cash on cash positive day one, which is amazing. But look at down the road. At year 11, she dropped her premiums down, by the way, she wanted to. She has access to $3,120, but the cash value went up by $10,590. Additionally, I'll note this over here, is at the end of year 11, she has put in $151,000, but the cash value is $185,000. And she's been loaning herself the monies during these years, but nothing has changed on this page. So extremely powerful how these things work, especially over time. Now, here's a quote by Warren Buffett. It's not my favorite quote, to be honest. It says, if poor people would just do what rich people do, they wouldn't be poor anymore. I like to say, if poor people had the knowledge and access of the rich, they could choose to not be poor anymore. That's kind of the way I look at it. And this concept is something that you can do. Wealthy people, they do this. And believe me, I have sat down with a billionaire and multiple multimillionaires, and most of them are doing infinite banking in some way in their life. So another question is, well, Brian, why you? Why would I want to work with you versus, my local insurance guy? Well, one, they probably don't do infinite banking or know how to do it, but I've been teaching infinite banking for 9 years now. I said 7, but I need to update that slide. It's been 9 years now. At the Money Multiplier here, BYOB team, we have an entire team of over 40 people that works with you. We are the largest IBC producer, almost, I think in the US, we're probably one of the largest producers of infinite banking. So for the companies that we work with, we are the largest brokers for those companies. So they like us, they work with us, obviously, and they like our clients. I pretty much at any point in time, I have over 100 clients in underwriting. So I work with a lot of people, and I have a lot of referrals, by the way. And then one thing we do that's very different is that we have a lot of ongoing support and services. Before, during, and even after you have a policy with us, we have a lot of support, and there's no cost to that. We don't charge you anything to do a policy, to do the application, to put in place. There's no cost you ever pay to us. So there's that right there. Another question we get quite a bit is IUL, which is an indexed universal life or a variable universal life infinite banking. The answer is no, it is not. IULs and term insurance pay some very high commissions. They're not structured the same way as the whole life policies that we build for infinite banking. We take a big cut in commission to do infinite banking. So that's how we build the cash value, by the way. And we will disclose all that stuff to you if you want. And then we only do infinite banking. We don't touch IULs. There's lots of problems with those that we've come across, and we have personal experience with IULs and whole life, and we will only do whole life. And most good infinite banking practitioners, which I'm a certified practitioner, we only do whole life, not IULs. All right. So last thing to kind of keep in mind here. So in life, one of two things will happen to us. Obviously, we're going to live. So are we better off with or without infinite banking? And then the other thing that'll happen is we'll die. We know that. So obviously, there's that guaranteed death benefit. So are we better off with or without this in our lives? I say yes to that. Right. There you go. So a quick little story here. So when I first came across infinite banking, I call it the tale of two people because I was one of these two people at different points in my life. I said, hey, I'm not going to go do this. I'm going to, with this person, I'm going to go to my friend, my buddy, and have him do this. Okay. That was group one. That was me. I'm like, no, I'm not going to go work with these guys. I'm going to go work with my friend who said he can do this. Well, here's what happened. He absolutely lost me around future value, about $200,000. Now, he ended up losing me a lot of money in some other things, but with infinite banking, he did not know what he was doing. He said he did. I lost a lot of money, future value money right there, right? And so I always want to be part of group two. Group two is, hey, I want to work with the best. Or when I hear about something that is new to me, I want to learn more about it, and I want to go learn from multiple people and make sure that I am part of group two, which is moving forward with the best knowledge and the best people to do what I want. So for me, I always want to be part of group two. It is why that I work with the Money Multipliers. Why I'm part of this team, by the way, is because I said, hey, I'm going to go work with the best people out there that I can find, and that was this group by far, right? So group one, go it alone. I've had a lot of people do this, and then they come back and they say, hey, can you fix, this policy? And I've done that many, many times, by the way. So here's what it is. Just hop on a call with me. Let's solve your problem. Let's answer your questions, and let's see if infinite banking is a fit for you. Because I truly believe in infinite banking. People ask me, well, Brian, if you're taking such a big cut in commission, why don't you do traditional insurance? Because I would not sell, and I'm not selling anything, by the way, but I would not put a traditional whole life or an IUL in place for my family, my friends, my own family, my parents, my brother, my sister, my wife, my kids. I would never do something like that with them. I would do infinite banking. So I'm not going to do something different for you that I wouldn't do for my own family and myself personally. So that's just my personal beliefs and my I don't want to say morals, but that's what it is. And so this is the last slide. I'll end it here. I love this quote because now it might make a bit more sense from when we started at the beginning. And so Will Rogers said, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. By the way, so on Wednesdays, we do 3 live events. So Chris Naugle and Steven, they do the WTF. It's, I think, at 6 or 7 a.m. Pacific, so like 10 o'clock, I think, Eastern. We have the Wealth Wednesday webinar that's also on Wednesdays. And then we have the Ask Me Anything at 4:30 Eastern, which is a live stream on his YouTube channel that you can come and ask questions live of our entire team. So just kind of keep in mind, you can go to chrisnaugle.com and get a link to a lot of those events, or go to Chris Naugle's YouTube channel and subscribe there, and you'll see a lot of our recordings there because they're out there. So have a great rest of the week, everybody, and we'll see you hopefully on one of our live streams or on a personal call. Take care.